Welcome to the ONO trading floor. Big thanks to ONO for being one of our sponsors today. I am Sophie Dicker. I'm one of the co-hosts of You're in Good Company, which is an Equity Mates Media podcast. If you haven't listened before, have a listen. Tell us what you think. Always reach out to us on social media. But that's why we're not here today. We're not here for me today. We're here to introduce Joe Wright from Airlie Funds Management, who is going to be giving a 15-minute stock pitch for one of his highest conviction stocks. Before we jump into it, I do have to give a quick disclaimer, which I'm sure you've all heard 1,000 times today, but all information presented today is for educational and entertainment purposes only. Any advice is general advice, and we don't know your personal circumstances, so obviously if you're getting financial advice, please seek it from a professional. Equity Mates Media operates under Australian Financial Licence 540697. Please welcome Joe to the stage.
I've just got the mic. Got the mic. Can everybody hear me? Is that all right? Sorry if I don't get used to the circular room setup. It's the first time I've ever spoken in this kind of space, but I'll do my best to make eye contact with everyone. My name's Joe. I am an equity analyst at Airlie Funds Management. I've been in markets now for about 8 years, and I'm here today to give my high conviction pick. It's not something I actually like doing. It's a bit of a one-way bet, to be honest. It's a bit heads you win, tails I lose, because if I'm right, well, that's my job, nice one. If I'm wrong, I'm a moron, which I may be, but we can talk about that later. Anyway, it's been a tough year for punters. You know, buy now, pay later doesn't make any money. Crypto's shitting itself. NFTs are very much a scam. Nasdaq's down 35%. And a lot of people, I think, thought, oh, this is brilliant. You know, I've got a side hustle. I'm building a dual income stream. Probably just addicted to vaping. And so am I. And that's fine. It's time to look at some businesses where the business model actually makes sense. You know, companies that have real assets, that produce real things. The stock market is a get-rich-slowly scheme. There's a raft of high-quality businesses listed on the ASX, industrials businesses, material businesses, businesses that produce capital goods, businesses that extract and process raw materials. They look really cheap right now. It would be shameless of me not to mention that I am the materials and industrials analyst at Airlie, and finally have portfolio managers listening to me after about 5 years. So let's get into it. My high conviction pick today is, something you want to own. It's fast growing, it's high quality, and it looks cheap. It's James Hardie, a manufacturer of fibre cement building products for houses. Now, before I get into what the company does a bit more, it's worth addressing everybody's first thought when they hear James Hardie, which is asbestos. James Hardie, in the early to mid-1900s, was the largest producer of asbestos-related fibre cement products in the world. And as the negative health implications of asbestos were coming to light in the 80s, they ceased production, developed an asbestos alternative fibre cement product that is still in use today. And the company has had a publicly checkered past of managing its asbestos-related liabilities. But the reality is they are now committed to fully funding those liabilities. And ultimately, it's an issue that is well understood by the institutional investor community. But for those not as familiar with James Hardie as some people, I thought it was worth addressing, just out of respect for anyone who might have been affected by it. As we all know, though, the market is forward-looking, and James Hardie's in a great spot. Sales and earnings have compounded at rates of 15% and 20% over the past decade. It's high quality. Returns on capital comfortably sit above 20% through a cycle, and at the moment are north of 50%. Strong financial position. Balance sheet is great. Debt is less than a year of earnings. The share price has gone up threefold over a decade, is up tenfold over 20 years, and it's actually fallen 40% year to date, which for us puts it right in that hitting zone of interesting companies to look at. Before I get into why the share price has fallen though, and what exactly that means for you guys, let's talk more about what Hardie's does. Hardie's manufactures and markets fibre cement building products for interior and exterior building construction applications. Got that straight from the website. They basically make planks and panels that go on the side of a house. Fibre cement is effectively a mixture of cement, sand, water, cellulose fibres, and some secret source of chemicals. If you've ever touched it before, it's sort of like wood mixed with cement. It's really durable, but sort of gets manufactured in these large sheets and then is cut into different shapes and sizes depending on the final product being made. And excuse me a minute. And Hardie sells this product all over the world. They sell it in most countries in the world. But the reality is, even though it's an Australian company founded by Mr. James Hardie in 1881 and listed on the ASX in 1951, majority of earnings now come from North America, and this is where investors should focus their time. So, we know what James Hardie does. Fibre cement, building product goes on the side of houses. Who cares? Houses have been built with brick, wood, vinyl, through time. Why does fibre cement matter? Well, when you're building a house, you sort of ask yourself three things. One, is the material I'm building this house out of going to last? Is it going to be around for the next 5, 10, 20 years? Or am I going to have to do this again? Two, how much is it going to cost? And three, is it going to look good? And fibre cement sort of sits at the nexus of these three questions. It's very durable. It doesn't go up in flames like wood or melt like vinyl. It won't rot or peel or crack in wet weather. If you're one of those investors who really likes to get in the weeds and touch and feel the products of the company you're investing in, you get in your car, go out to the suburbs, you'll find a house made of vinyl and you'll find a house made of fibre cement. If you're a big strong guy, maybe you, sir, you won't be able to put a dent in a fibre cement wall, but you will probably be able to rip vinyl right off the side of the house. It has the consistency of a milk carton. It's nasty product, still used on 35% of houses in the US today. And so, from a cost perspective, fibre cement isn't always the cheapest up front, but when you factor in things like the cost of painting wood or the maintenance of fibre cement over its life cycle, maintenance of brick or wood over its life cycle, it stacks up really well. And finally, home builders love it. It comes in an endless permutation of colours, shapes, sizes. Stick it right on the wall. It's easy to install. It's not heavy. And so, from our perspective, it's a very compelling offering versus the other alternatives, or the more traditional alternatives. So, we like fibre cement. Why James Hardie's? Why not another manufacturer of fibre cement? Fuck, I've got a good answer for this one. They make 90% of the world's fibre cement. There is no competitor. That competitive position is a function of three things. One, they have a scale manufacturing position in North America that basically means their lowest cost of production in every region of the States. Two, they have IP around the fibre cement formula and the manufacturing process. And three, they have a cost structure in place with their distributors and the builders ultimately that allows everyone to earn a healthy margin. The dealers and the builders are incentivized to use this product because they make more money. And so it's really those three things that have combined over the last sort of 20 years to allow Hardie's to extract high returns on capital through time. So we like fibre cement. Hardie's looks like a good business, but it's already 90% market share. How much more can it grow? Well, even though it's 90% market share of fibre cement is still only used on 25% of new builds and 9% of renos. Hardie's has been growing volumes at 10% annually for a decade, and they've not even cracked the reno market, and renos are 65% of their sales. The opportunity to grow is right in front of them. 60% of houses in the US are over 40 years old, which means they're going to have to come down and get rebuilt or get renoed within the next 10 to 20 years. On top of that, most economists estimate the US is still short about 4 million houses. So we like fibre cement. Hardie's good business, big runway of growth. Why the fuck's the share price down 40%? Very obvious answer. I'm sure you've been hearing a lot about it. Interest rates. The market is assuming that rising interest rates will lead to a slowdown in US housing activity. Completely fair assumption. If I got up here and started arguing that there wasn't going to be a US housing cycle, I would get fired. So I'm not going to do that. The reality is, I think there will be a cycle, but I do think the market has already priced in a deeper cycle than is likely and is using the sort of GFC as its closest point of reference. Reminder, the GFC was the worst housing cycle on record. There's a couple of things I want to point out that are different to the GFC. One, US household balance sheets are in a much stronger position. On average, the average US household's equity versus the value of their home is 50% higher than pre-GFC. Two, in the US, in the GFC, we had housing starts go from 2.2 million, the highest peak ever, down to 500K, a collapse of 80%. There is just no way this cycle can be of the same magnitude, partly because we didn't even reach the same peak. And so how can the market contract as much as the most devastating cycle we've ever experienced? Seems unlikely. And remember, 65% of James Hardie's sales come from renovations, not even new builds. So if you're a US homeowner who's cashed up and you're worried about moving house because of the cycle, you're going to spend that cash on your existing home, renovating it for the next upcycle. If I model out, say, a 50% decline in US housing starts from peak to trough over the next 2 years, which would be the second worst housing cycle since 1971, not as bad as the GFC, but the second worst. I get Hardie sales down about 15 to 20%, earnings down about 30%, which puts the business on an enterprise value to EBIT multiple of about 16 times. That's in line with the ASX industrials. It's in line with where Hardie's traded at the past decade and below that the last 5 years. So from my perspective, the only thing that has to happen is the cycle will be less worse than the GFC and the stock looks at good value. The long-term growth opportunity is unchanged, regardless of a cycle. Seems like a pretty decent bet that I'm happy to take. It's a top 10 position in all our funds as a result of that. And I'm saying buy the dip effectively. You've got a great business, you've got a long runway of growth ahead of it, and you've finally got the share price back in the hitting range. To us, that's a compelling opportunity. That's it. No slides. I think we've got, if you scan your barcodes, there's a prize you can win in the Early Australia Investment Fund. Thanks for your time.
Thank you very much, Joe, for that one. Just a reminder, none of this is financial advice, buying the dip. Remember that one. Next up, we have Kieran Moore from Munro Partners, who will also be giving his 15-minute stock pitch. Welcome, Kieran.
Thanks very much. So at Munro Partners, we're massive believers in decarbonisation. Okay, we think decarbonisation is going to be the next big theme for investment over the next 20 to 30 years. And so as a growth investor, we want to invest to be able to capture that opportunity. We think the money coming to this space is going to be about $50 trillion to effectively decarbonise the whole planet. And so we want to capture that opportunity. We want to invest in companies that provide solutions to grow their revenue, their earnings and their cash flows from providing solutions to help decarbonise. We think one of those potential opportunities, one of those potential emerging winners is a company called Alfen. Alfen is an 85-year-old, €2 billion market cap company. It's listed in the Netherlands, and what it's done over those 85 years, since 1937, is really provide industrial solutions for Dutch grid operators. So basically upgrading the Dutch electricity grids. Alfen came to market in 2018. So it IPO'd in 2018, and its goal was to effectively provide energy solutions for the future. So over the last 10 years, Alfen's been able to reposition itself. So not just provide those industrial solutions to electricity grids anymore, but to provide new and exciting businesses that help enable decarbonisation. So today, Alfen operates 3 business segments. The first of those is what's called its smart grids business. And this business is actually split in two. So this is split into 2 business lines. It's transformer substation business and its microgrid business. So what Alfen does under its transformer substation business is effectively that core competency it's been doing for 85 years, really providing those industrial solutions in terms of upgrading electricity grids in the Netherlands. When we think about that $50 trillion that we think it's going to cost to decarbonise the planet, we think roughly 12% of that 50 trillion is going to go towards transformer and substations and grids all around the world. So solutions like Alphen's are going to become critical for governments as they upgrade their electricity grids to be able to deal with things like two-way flow from renewables coming onto the grid. Alphen's transformer substation business is really the core of what they do, and that grows at about 8 to 12% per annum. The other part of its smart grids business is what's called a microgrid business. And a microgrid is essentially like a mini electricity grid. And you build a microgrid next to a place where there's an increased demand for electricity or increased demand for power. So next to an onshore wind farm, for example, next to a solar PV park. And what that microgrid is aimed at doing is really providing an element of control and optimization of how that power is captured and deployed. And so this is one of those new and exciting opportunities that Alphen has gotten invested to over the last 10 to 15 years. It's been able to take all that industrial capex or industrial work that it's done over a period of 85 years, that technical expertise, and build it into this microgrid business. And so we think that business is growing in the high 30% range year on year. The next division Alphen operates in is an energy storage solutions business. So if we think about a world in the future where we're going to need more and more renewables coming into the grid, renewables naturally will need energy storage solutions. Things like onshore wind, offshore wind and solar, naturally they're constrained by weather conditions, by daylight, etc., etc. But the biggest demand time or the biggest demand profile for energy use is obviously in the morning and the evening when people are awake in their homes. So storage becomes vitally important because storage means that you're not flooding the electricity grid with renewable energy at the wrong time of the day. Storage means you can optimally deploy that energy at peak demand times where it's going to be most used in the best fashion. So Alphen operates an energy storage solutions business. It makes small energy storage solutions that are temporary and can be moved, and it also makes commercial grade systems that are more permanent fixtures that sit next to those onshore wind farms or that solar PV park. We think this is a really exciting part of what Alphen does, and we think this business has the capacity to ramp significantly over the next 5 years. If we look at the total addressable market for energy storage that Alphen operates in, we think it's in the multiple billion euros. That compares to Alphen's very, very small revenue from energy storage solutions in the last few years. The third and most exciting part of what Alphen does is it makes EV chargers. We think EVs are right at the inflection point, i.e. the penetration has been building and now it's starting to accelerate. We think that penetration and that acceleration in the EV space is going to continue. And so what's really important about that is that you need to invest in the critical infrastructure to support that EV ecosystem. What's fascinating about the inflection that we've seen in the EV market is that it's really been driven by the EU. And you've got some big markets to come behind. So what Alphen does is it makes EV chargers. These EV chargers can go into your home, they can go into your workplace, they can go into supermarket car parks and public places. And their chargers operate almost like a social charging network. They've got that connectivity to be able to optimally deploy charge to manage the car load that's required. So it can manage demand. It can use that energy efficiency that they've been able to build up and that technical expertise they've built up over a long period of time to deploy in an efficient manner. So Alphen, the TAM for its EV charging business is about 5 billion euros, we think. So it's a 5 billion euro opportunity from a revenue point of view. But last year in 2021, the revenues from this division was only about 100 million euros. So we can see a massive runway for investment here, a massive runway for growth. We think Alphen's EV charging business is going to grow at in excess of 100% this year. In its most recent quarter, the EV charging business grew over 200% versus its prior comparison last year. We think that clearly demonstrates the inflection that we're seeing in the EV market and the acceleration in that market. So putting it all together, Alphen operates in 3 really exciting business lines today: smart grids, energy storage, and EV charging. We think one of the most attractive opportunities about Alphen is that it's actually able to cross-sell its products. So for example, if one of its customers want to build an EV charging network in their car park, they might also purchase a microgrid solution from Alphen, or they might also adopt an energy storage solution from Alphen. So in the future, Alphen will be able to sell all their products, all those energy solutions for the future, to effectively one customer each time. And so we think Alphen is expected to grow its revenues at in excess of 60% this year. We can see a path to Alphen getting to €1 billion in revenue by 2025 versus the 249 million that they made last year. That's a significant runway backed by a massive structural change. Now you might think, well, that's a small cap, it's growing quickly, does it make any money? Alphen actually makes great money today. It makes a really profitable EBITDA margin. When it IPO'd in 2018, management had the target to have an EBITDA margin in the 15 to 20% range in 5 to 7 years. After only 4 years, in its most recent quarter, Alphen delivered an EBITDA margin over 18%. So you've got a massive total addressable market, which Alphen is only a very small part of today. 3 very fast-growing businesses operating at a decent profitability level. So let's think about valuation. Alphen has always typically traded at a premium valuation to the market, so more expensive to the market. We've always looked at Alphen and valued it on an EV to EBITDA basis. So that's its enterprise value divided by how much EBITDA we think it's going to make over the next 12 months. And we think a premium valuation in this case is warranted. It's warranted because Alphen's in a large total addressable market that's growing. Alphen has demonstrated its ability to monetize or leverage that growth over time. And we think that growth is sustainable because it's backed by a massive structural tailwind. A massive structural tailwind that is the decarbonisation effort. Another factor that's really important to us and why we think it deserves that premium valuation is the management alignment. So we're always looking for good management alignment with the shareholder base. The founding family is no longer involved in the company, but the CEO and CFO have both been at Alphen since well before the IPO in 2018. So we think they're well incentivized to get this job done and to grow this business significantly at decent profitability levels over time. So we think they're highly aligned with their shareholder base. The last thing we always look for in any growth investment that we do is we think to be a great growth company, you have to have a great product. And so Alphen's product, by virtue of the fact that they've been able to expand their products all over Europe and grow their EV charging, grow their energy storage business, grow their microgrid business all over Europe, demonstrates the fact that that customer perception of the product is extremely high. So to wrap it up, Alphen is a very small business today. We think it operates in a market backed by a massive structural change, a massive opportunity for the equity market over the next 20 to 30 years, as more and more companies develop these critical solutions to help enable decarbonisation. Alphen operates right at the start of the S-curve opportunity today, and we see a long runway of growth ahead. Thanks very much.
Equity Live. I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.